You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Coffee with Cott, where advisors can find out what is brewing in the options space with your host, OIC's Director of Education, Eric Cott. OCC was created in 1973, and OIC is an industry resource supported by OCC to provide trustworthy education about the benefits and risks of exchange-listed options. Since 1992, OIC has been dedicated to increasing the awareness, knowledge, and responsible use of options by individual investors, financial advisors, and institutional managers. Before we get started with this show, investors should know that options involve risk and are not suitable for all investors. You should never enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margin interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as recommendation to buy or sell a security or to provide investment advice.
Welcome, everyone. I am your barista for this program. So glad you can join us. Please go ahead and fill up your cups with a hot beverage of your choice. Whether you're cold brew, double espresso, mocha, cappuccino, grande type, we have you covered. On this show, we pour over topics that relate to your practice, your clients, and options. Hello, my coffee compadres. I am Eric Cott, your head barista here at Coffee with Cott. Now, I hope you all have your extra grande, extra caffeinated beverage today. This podcast, we have two dynamic individuals for this topic: ETFs, exchange-traded funds, and options. Both gentlemen, longstanding friends and colleagues to the OIC. Eric Balchunas and Dave Nadig have been frequent keynote speakers at the Inside ETFs conference in my backyard of Florida. Little shameless plug there for the state. And I've been fortunate to know these icons in the ETF space. Eric having spoken at a prior OIC FA forum, and David being an employee of one of the large option exchanges. You could tell I'm super, super energized to have both of them in the Coffee Cafe. Let me start up north with Dave Nadig, Managing Director of ETF.com. Welcome, David. Maybe you could share with our listeners a little more about your background.
Sure. So I started in the ETF space back in, 1992-ish, when I went to work at what was then Wells Fargo Nikko Investment Advisors. And then we saw the launch of the very first ETFs right around that phase, and Wells Fargo Nikko, in concert with Morgan Stanley and a few other folks, put together a set of products called the WEBs, the World Equity Benchmark Shares, and I was one of many, many, many people on that team. Definitely not a father of the product. I was one of the kids getting coffee at the time. But those were the first ETFs that I had really ever seen and interacted with, and throughout my career, I've had various roles that have kept me in the ETF business, as it were. And I came over to ETF.com almost exactly 10 years ago. And our goal at ETF.com is just to sort of be the go-to source for the financial advisor who's using ETFs or wants to use ETFs in their clients' portfolios.
And that's interesting, David, because that's kind of when you and I started to get to know each other. I am celebrating my 10-year anniversary at OCC OIC, and you having gone through the iteration with being with Bats, which purchased ETF.com, and now with SIBO. I shouldn't say the CBOE. It's now SIBO. I have to make sure that I pronounce that correctly. But a lot of correlations between us, and we'll talk a little bit later in the podcast about some of the things that we've had the good fortune, and we appreciate the ETF.com folks, you and Drew, to include the OIC in some publications. Now, I'm about to say direct from Bloomberg Television Studios in the heart of the Big Apple, New York City, author, TV personality, Eric Balchunas. Eric, welcome. Can you also share a little bit about your background with our listeners?
Yeah, and by the way, it's the opposite of glamorous. I'm in Center City, Philadelphia, and it's gray and overcast. Yeah, and I'm in my research hole, which I'm mostly in. Most of my week is just in front of a computer trying to do research, and then Wednesday I go to the big New York office, and I call it the Media Blitz Day, and then I just cut it back to Philly or Princeton to do more research. But anyway, I started my career as a financial journalist for Institutional Investor, covering derivatives and then funds. Then went into PR for a couple of years, which is the dark side if you're a journalist. So that was a good experience. And then I got a job at Bloomberg PR. And then around 2002, right after 9/11, I moved to the data office of Bloomberg in Princeton. And I spent 15 years there. And where I ended up in data was funds, because I had that funds job earlier as a reporter. So spending 15 years just building up the terminal, that's like where the Keebler elves of the Bloomberg terminal are. In fact, I even have a shirt that says "Time to make the data," referencing those old Dunkin' Donuts commercials. But we built out the ETF database, and that's what I spearheaded in 2006-ish. And right away, it took me pretty quickly to see ETFs were going to be a big deal. I think if you were, just the kind of person who's got his antennas up, you probably noticed that as well. And so I immediately just dove in, went to Dave's conference at Inside ETF, saw Matt and Dave present in front of the big screen, and I was blown away. Not only was it the future, but the way they presented was so different than these boring financial conferences. So I didn't just like the product, I liked the vibe. And so I just became full-on ETF person at Bloomberg. And then I got poached by the research group to head up ETF research. And then from there, I had been doing some TV work all the time, and they started an ETF show and a podcast. And I kind of was, natural to be chosen for it, but I'd also sort of like driven a lot of the moves to get that done anyway. So mostly my job now is in research. And then I do a little media on top of that, which is largely talking about some of the stuff we've researched. And now our team is 4 people.
And Eric, you've also been a great supporter of what we've done at OIC. As I mentioned earlier, you came out and were kind enough to provide your book to a lot of the advisors when you had published that and released it. And maybe a little bit later, we'll talk a little bit about that. And have also invited the OIC to be there in New York studios, not only for one of the shows, but I really have to extend my thanks to you. We had university students come in last year to get to tour the exchanges, but also to get to see the nuts and bolts of the Bloomberg studio. And that was really special for me. So I want to thank you and the Bloomberg folks once again for that. I'm going to turn to David. And David, one thing I believe you mentioned already, you were a co-founder of Cerulli Associates, my 2 guests today, and folks who are listening are familiar with it. If you're not, you can go to the website. But David, I'm a history buff. My college major was in history, and yes, my 2 older brothers, who I believe are listening, I did actually get a diploma from Wisconsin, so it's there in my house. I could show the 2 of you that. But David, you were involved in the early design and development. You mentioned this decades ago on some of the first ETFs. I'm going to fast forward 2019. Did you ever believe, and I'll bring Eric in after, did you ever believe we could be at almost about a $4 trillion level?
No, and honestly, I'll cop to an even more embarrassing thing. When I first saw the plans for some of those early ETFs, I was enormously skeptical because ETFs suffer from, if you imagine a world before the first ETF, there's this huge chicken and egg problem, right? We knew going in that we had to create things that would attract market makers to come in and do the arbitrage that generates enough profit for them that they're willing to make markets in these, newly minted securities that sort of, nobody's seen before. And at the same time, we had to create enough liquidity for the end investors, which, at that time we believed were going to be almost exclusively institutions. And so there was this crazy thing of like the day you got the first ETFs trading, how was anybody going to care, right? Because you didn't know whether you were going to get any money in to actually be able to run the funds. And at the same time, would anybody trade them and how wide would they trade? And so I was enormously skeptical that these, newfangled things were going to work at all. And so, as we got towards the end of the decade, 1989, 2000, 2001, where we had a few dozen ETFs that traded reasonably well, by then, obviously, my skepticism had, waned because I'd seen the value of the tools. And at that time, I was actually an active mutual fund manager, and I was using, various ETFs as sort of cash equitization vehicles on a regular basis. And then I really was a believer. As we headed into the early 2000s, I knew that we were going to be just in an incredible position. And, the last 19 years, while it's been super exciting, I don't find it super surprising. The tools themselves are just so much better than most of the options, pardon the pun, investors have for getting similar kinds of exposure.
See, that's a real good background and a transition, because I wanted to, Eric, I wanted to ask you, because David just talked about 40 Act and mutual funds having some background, and Eric, Morningstar has the category and option-based funds. However, we're seeing a lot of it on your show, Eric, more of these ETFs that focus on overlay strategies, options. There are providers offering sort of alpha and hedging solutions, buy rights, covered calls, put right, ETFs. Eric, how come advisors seem to be receptive to these sub-advisor solutions for their client base? I'm also going to add two parts to the question, so it's sort of three parts about the reception on the part of advisors. Are there more to come in years ahead? And will some of these possibly close and not be around? You have the pulse.
Yeah, so you're right. I think the ETF structure is like it's so durable. Well, I guess you could say it's a blank canvas. I mean, you can really put anything in there for the most part. And I call what you just described sort of package trades. That's my sort of Eric term for them, because they're doing like A plus B, A minus B, or A plus B minus C. They're doing like one or two things that have been done for years. It used to just be used to be an institution who had a desk or traders at your fingertips to be able to do these trades, but retail tended to not do them. So like currency hedging is another example, options overlays. They're not new inventions. They're just packaged and democratized in the ETF structure. So it's not a shocker that something that is convenient for people would have some success. I think for the most part, people tend to gravitate towards the cheap beta ETFs, but there's room in the smaller categories for products that do specialized tasks. And, whether that's the downside protection ETFs, the options overlay ETFs, and some have had varied success. Like any category, there's going to be some winners and losers. I think in that category, you're going to charge a little more, so you don't need as much assets to make a profit. So, that's a category where the funds can probably live off of 30, 40 million if they will. So, we bring them up from time to time in our research and on the show. And I think they're, obviously good solutions, and I think they speak to democratization, and by the way, just as something Dave said, which I always try to remind people this, like $4 trillion in ETFs, you got to remember that's $4 trillion the hard way. There's no kickbacks, right? There's no 12B1 fees. You're not paying anybody to buy them. I think 2008, was the year that made ETFs. I thought they took a beating and they kept on ticking. And I think a lot of institutions were surprised probably by that, or maybe just they were needing some liquidity, and they found them useful. And so that's when I saw a lot of institutions come in. And then I also think retail got more into passive after 2008 because a lot of active managers failed to do any better than the 35% the market lost. So I think 2008 to me was the year where those asset numbers started to really jump up, the flow numbers rather. But anyway, I just wanted to add those 2 points to Dave's earlier point.
And to the question also with bringing David back in about the reception of advisors, because you both talked about the Inside ETF conference, and gentlemen, you know this space better than most, better than Todd Rosebluth, better than Tom Lydon, Matt Hogan, John Swelps. And this is a shameless plug to get our colleagues, the three of us and friends that we all know, to call the Coffee with Cott hotline so OIC can schedule them for an upcoming show. So that's why I'm mentioning their names right now. But you've had more advisors, Dave, and Eric's seen it at the Inside ETFs conference. But this provider, we're seeing more providers offer strategies that provide this income alpha solution or hedging downside risk. Look, options are not always on the forefront of the advisor's mind, but Eric, you just talked about 2008. I joined in 2009. We saw, some real key volatility that occurred just last year in February, but we go back to 2008. So as you said, Eric, and I'll throw this to you, David, 2008 was sort of a pivotal year. We did see some parabolic growth in the ETF space now up to today. So with more sub-advisors offering strategies, Dave, you've done a lot of interviews with folks and you have people on your show. Is there the potential that we'll see more of these strategies in the options side come out from other providers? I know I'm not going to mention specific names, but some providers who are really large have kind of been reticent to offer these strategies.
Oh, yeah, for sure. I think, if you think about the growth of ETFs with advisors, that 2008, 2009 era was really pivotal. And I think advisors came away from that experience with a few sort of life-changing insights, one of which was, look, hey, we might as well control costs since I can't control anything else, obviously. And that's been huge. So as people, got hit in their positions during that time, maybe they traded underneath where they would have had capital gains before, they rotated into ETFs out of mutual funds that were probably underperforming, probably actively managed, and probably very expensive to low-cost beta. And so that was a huge push. And that helped educate a whole generation of financial advisors and their clients about what ETFs are and what they do. Options-based strategies packaged up into ETFs make a ton of sense in that environment because the whole reason somebody goes to a financial advisor, this sounds axiomatic, is they need advice. They have something about their situation is not so ridiculously simple that they can just do it on their own. And once you have a slightly more complex financial situation, whether that's your risk tolerance or trying to put some bumpers on the bowling alley of your investor experience, those become really important tools. And so I'm actually a little surprised how long it's taken for the U.S. ETF market to bring a lot of these strategies out. In other markets, Canada in particular, options are used extensively within ETFs to smooth out your experience, to hedge downside risk. So I think there are again, pardon the pun, I think there are a ton of options here that still haven't even been explored. Really, if you look at the list of ETFs that sort of have options in the headline, it's still a quite small list. I mean, I think there are probably room for 100 or more other strategies to come to market that bring the unique sort of pattern shaping that you can do with options to all sorts of asset classes.
Eric, do you want to add a little bit about that? Because you both are familiar with the fact OCC had its record volume in 2018. We cleared, over 5 billion contracts. And a lot of that percentage was ETFs. We've seen a lot more reception in the retail institutional. However, the advisor space is now embracing ETFs, whether strategies offered by ETF providers or hearing on the road when I am out there that advisors will say they might call a client and mention Mr. and Mrs. Smith. If I could add dividend income to a non-dividend producing holding, would you be interested? We can, write a call against our ETF. So, Eric, do you see more of these funds coming out?
Yeah. I mean, I wouldn't say they come out like on a steady drip. It's not like, say, where something gets like the currency hedged craze. You see hula hoop type crazes every now and then. I wouldn't call them, they're not coming out like that. It's not like a fire hose. But yeah, they come out persistently. The reason these are, in my opinion, useful, and maybe they haven't even had their day yet, is a lot of them depends on which type you use. But if they're providing that downside protection, I think these things could have their day in the sun if they provide some downside protection. The income could also come in handy if rates remain low during the next downturn. They could be in the sweet spot. So I think any assets they've gotten in this time is largely for solution to sleep at night. But we've seen that usually an ETF category or a type of ETFs tends to only get to the big boy level when the stars align for it. So I think some of the income that you got from some of these option overlays probably was in the mix, but they were competing against dividend ETFs, junk bond ETFs. Like there's like 10 ways to get 4 to 6% yield, right? So that's one way. The other way is the ones that do provide some downside protection. You give it some of your upside. Those to me, like the innovator ones that we had mentioned earlier, those are probably going to have their better days after the market stops being so good, in my opinion. And I think there's a lot of those that if they just hang around, I think they're going to see some big boy flows because there'll be such a demand for them. It's sort of like, and I equate this, people buy the umbrellas outside of Penn Station when it's raining. They don't tend to buy them 2 days before.
That's true.
So I do think that's when you'll see a lot of that. But you have to keep in mind, though, there are a lot of advisors and, as you said, institutions probably are the bulk of the volume. Dave may know better. You may know best. Is they're using options on ETFs themselves. So they're just, using like SPY options are big business, right? There's a ton of options on those. The junk bond ETF options market on HYG in particular is massive now. So a lot of people might just be using options themselves. But for certain advisors and institutions, they can sort of have, do it themselves with both pieces, if you will.
Well, I like the play on words, Eric, that you said it's a steady drip. So I appreciate you doing the coffee analogy there. I'll ask David about the buffer notes because that seems to be a topic in the ETF universe that is a lot more frequently referenced in the press and around the advisor water cooler discussion. So, David, any thoughts on that?
Yeah, I mean, I think that sequence of products that's come out, and I'm sure we'll see competitors to them, which use strips of options to effectively give you some equity exposure and cap your upside, but at the same time it also insulates you from the first X% of your downside risk. That's not a new strategy at all to anybody who's traded options before. It's quite literally something you would see in an options textbook. But the innovation there is launching a whole sequence of these products so that you can get in a particular month and you'll have a specific experience through the expiration of the underlying options there a year later, and they're starting to roll those out across different indexes. So we're not just talking about the S&P 500, we're talking about international markets as well. I think there's a fairly wide amount of room for those types of products, and they've gotten good adoption. I mean, there's hundreds of millions in those products a year in, which is I think pretty impressive. And to Eric's point, if you were a large institution, you probably would have just you'd implement this strategy on your own and not bother paying expense ratio. But if you're an advisor, an individual investor, despite the fact these things look a little complicated on the tin, or on the bag of coffee, as it were, Eric, they're actually quite simple in terms of what they do for the end investor. And I think it's one of the few things I've seen in the ETF industry in the last 5 years that's truly innovative, that's actually providing a very different pattern of returns for investors than they could get without doing an awful lot of work on their own. So I'm super excited about these products, and I think they've got a pretty good runway of opportunity in front of them.
We're excited as well, obviously, at the OIC, because a lot of the discussion revolves around the do-it-yourself or the advisors that are out there, whether they're FAs or RIAs, independent, et cetera, that are sort of like an institution managing positions on their own. But I go back to this parabolic growth in the 40 Act or ETF or SMA space where advisors want to hand that fiduciary off, not worrying about assignment risk or having to send an ODD, but bringing in a professional that can manage. So, Eric, one of the things that has happened in the past 12 some odd years as well, we go back to 08, 09, and we've seen a lot more in the media, print media, digital media with David's company, but also TV. I was going to ask you, Eric, to elaborate a little bit more with the Bloomberg terminals, but also with the television program. Media has played a role in, I believe, I'm asking this rhetorically, Eric, the growth of ETFs and more wider acceptance. And that also plays into this discussion of where providers see their volatilities on the mind of a lot of investors and advisors. So why don't we look to package some sort of strategy that can protect on the downside? So this whole theme of media, Eric, which you're really, of course, connected to, no pun intended, how has that played into the growth of ETFs?
I have this chart where in one of my presentations, I think it's called the Internet Theory. And this theory put forth by Michael Kitces he says, Internet killed the active manager star. And he basically says once the Internet let information get spread out, it was just pretty much game over for active mutual funds because people could then, easily see how they were doing. They didn't just get one statement mailed to them. They opened it up, I'm up 5%. They realized that 5% wasn't that good. And what happened is the bloggers, to me, were first on it. Then you had some of these conferences like Inside ETFs. Then you had like I call it the trade publications that got this early, like an Index Universe, like a Morningstar. And then the mainstream media, to me, came in around 2013. That was when I saw something in USA Today, which to me is sort of the end of the media line. Once it's in USA Today, it's kind of like, that's it. In fact, yesterday, I saw the Star Ledger of New Jersey. The question was sent in by a reader, what should I use, index funds or ETFs? That was shocking to me because active wasn't even a choice from this person. And this is a total local newspaper. So I tend to follow some of this to see where we're at. CNN, local papers, they're now just, I think, where Dave and Matt were in like 98, they're maybe like, 20 years behind, but it took mutual funds like 100 years to get their size. So I think that's fine. So I do think the media's played a role. I think having, Bloomberg Television and CNBC, a lot of that's people talking to people who probably already know. I'm assuming that a lot of people who watch those it's on trading desks. Maybe if anything, it's do-it-yourself retirees. They've probably heard of ETFs already. So I'm not sure there's anything new there. I do think those shows are good for drumming up good factoids on ETFs, new products you might not have heard of, educational things that get sort of borne out in a conversation on a topic.
It's an interesting perspective, Eric. David, you have had experience as well in the advisor space, and I sat for many years in a chair with a firm that had a bull as their logo. So I remember when ETFs were sort of introduced. I believe actually I had a long head of hair then, and I was a lot younger. But I'm not going to bring those thoughts up at this point. However, it was over time. I do recall being an advisor, working with clients, and hearing some of the chatter in what we would refer to as the bullpen, because I sat in a cube and we had so many advisors there talking about this unusual investment that had a low cost and it was traded during normal market hours. And wow, you could do size and style and asset allocation. And there weren't a lot of choices. There weren't a lot of blends. I'm going to throw my coffee analogy in. There weren't a lot of blends that you could use, but now we've really seen this growth. So part of this question that I asked Eric, I'll ask you, David, with media, and you've seen tremendous growth from your side, digital and print, and we do appreciate being a part of the print publication and sharing some stories on volatility and quantitative analysis with some of my colleagues. Your thoughts on that, David?
Well, I think there's a bit of a double-edged sword here. Eric's definitely right that, this has been a particularly great year for the sort of ETF-centric media, between sort of Eric's show and what CNBC's been doing. So it is definitely much more front and center. The flip side of that, however, is anytime anything goes wrong, everybody's pointing the finger at ETFs. They're trying to figure out a way to either blame it on ETFs or figure out whether ETFs caused it or what the impact is on ETFs. And I'll be honest, that game gets a little tiresome after a while. I think ETFs get held up as the boogeyman for everything from the market being too volatile to the market not being volatile enough. I mean, I've literally had that call come in to me from the press in the last month, in both directions. So I do think that there's a double-edged sword in that media coverage, but I don't see anything coming in to replace the ETF in the next few years. I think longer term, maybe there are some competitors for it, but I think this is the world we're in now, and for better or for worse, ETFs are going to be in the spotlight anytime anything interesting happens in the market.
Well said, David.
Can I jump in there?
Sure.
Dave, were you reading about that Woodford fund in the UK that basically wouldn't let investors redeem their money?
I know I wasn't reading about that, but go ahead. Please go on.
Exactly. Basically, a huge fund in Europe wouldn't allow investors to get their money out. It just halted redemptions. Could you imagine if that was an ETF? I mean, the fact that you didn't even hear this fund is case in point. It is weird to me how my theory on why ETFs get so much angst is I have a couple theories. I mean, if anybody wants to chime in here, I think a lot of the coverage maybe is people who didn't maybe have a large background in mutual funds. If you understand mutual funds, I think it makes you look at ETFs differently than if you just start looking at ETFs. You may view an ETF as like some kind of a derivative thing. Whereas if you really know the mutual fund, you realize that it's just a mutual fund with some benefits. That's one. Number two, I think ETFs are what you see in front of you. You can see flows, you can see pricing, you can see data. They're usually like the tip of the iceberg of something larger underneath, like the XIV instance where that fund honestly probably deserves some of the bad press. Was it a wild product? Sure. But it did what it was supposed to do. But really, it only had like $1 billion. But it was definitely symbolic of a larger trade underneath. And so I think like if there's a junk bond sell-off and nobody can sell junk bonds, say, for a couple hours one day, HYG will be in the crosshairs because it's sort of what you can see. It's just a poster child for something deeper going on. So ETFs tend to get that kind of attention. And I also think that I've written stories like, and I've seen it on Bloomberg, if you write ETFs did fine today, no one will click on that. If you write, ETFs, weapons of mass destruction, you'll get like exponential more readership. So it kind of also goes into the fact that, adding the negativity and the worry will get you a lot more eyeballs.
Well, Eric, it's interesting because that is one of the things when I'm out there in the field, and both of you are aware of that, when you initially mention the word options, the advisor's hands go up. That's risky. That's a weapon of mass destruction. They heard that back in 08 or 09, or it's toxic. And you start to say, well, wait a second. You have a lot of flexibility when you utilize options with clients, whether it's on a stock, an index, or ETF, and that you kind of control. You could control the risk there with the expiration, the premium, and such. So I understand the point, Eric, where when you had a negative connotation, it tends to maybe draw some more mice to the cheese and more clicks to the story. So, well, listeners, we're getting sort of towards the end here, and you're always aware when I have wonderful guests like this, I always like to ask them on CWC, and this is for our listeners, some fun facts. And I'll start with David. If you weren't in the investment world, the educational outreach, media, etc., what do you think you would be doing? My hunch, maybe I'm a 50 delta on this, David, that you would be a European hiking tour guide in the Faroe Islands in Iceland. Is that possible?
That's not a bad guess. I am an outdoorsy kind of person. I do love my time in the woods, but no, honestly, I think I'd probably just be a writer in a different place. My undergraduate experience was as a creative writing major, and then I went back to business school later on. And so I think I would be a journalist in a different field or something like that. So it's sort of accidental that I made the jump from being a writer to, at one point actually running money and all of those things. And now I'm sort of back in the media space, but tied very much to the investment world. But I think I would still be a writer of some kind.
Well, that'll transition me to Eric Balchunas, who once again was kind enough to bring his book in 2016 when we did the FA Forum. My thought, and this is probably maybe a smaller delta, maybe a 40 delta, that Eric Balchunas would be quarterbacking for the Eagles, or he would have been the choice over Bryce Harper for the Phillies. So, Eric, if you were not in the media and the investment world, tell our listeners what you might be doing.
You're warm. Backup point guard for the Sixers.
So we're
no. I do love basketball. I still play, but I'm like a TJ McConnell type guy. But as you get older, I've been working on my 3-pointer, and it's been keeping me alive in these pickup games. But anyway, I'm also a writer at heart. I feel like that's where I'm happiest. If I wasn't doing this, and I may expand in my career to do some stuff that's outside of ETFs, but like you bring up the Eagles. I have a great book idea for a history of the Eagles fans. I think it's a target-rich environment, a misunderstood base, and I like books where I can interview people. The book you mentioned that you were so nice to buy some copies of at that conference, I interviewed 50 people, Dave being one of them, and put their quotes in the book. And these are, I like it. It was like almost like a half documentary type style. And I feel like there's a lot of topics I would like to do that with. Debt is another one. But it's tough to do a book. I mean, that just eats up like a lot of your downtime. And the problem is, you have to have a day job. So there's a lot of tension with this, but the reason ETFs are so much fun to cover and keep me, really engaged is that they cover everything. ETFs make you be a mile wide and a mile deep. Normally, you just need one or the other, and they take you everywhere. On the show last week, we went to China biotech, we did Tesla, and we did the trade war ETF. I mean, all those things are really intellectually stimulating because there's all these new places you're thrown around to. I enjoy that a lot, and I also think that as a writer, your skill is to take some things that might be a little complicated and make them simplified, which I think I'm decent at, and Dave is also excellent at in terms of explaining these things to people. So I think I'm in the right spot, but I could also, I could be, the next walk-on for the Sixers. We'll see.
Well, we're going to look tonight on the draft and see what happens if you end up getting drafted before anybody else. But with that, I'm going to ask you, Eric, while you're still on, and then I'll ask David. Another question I always ask my guest is, what is your favorite brew when you're sipping a cup of Joe in that lair of yours in Philadelphia?
You mean, I'm going to be boring. There's a city diner right down the street, and I just like that diner, and they serve it in those sort of classic mugs. It's like straight out of like the beginning of Reservoir Dogs diner. You know what I mean?
Of course.
It's that kind of diner. And I go there a lot for lunch if I'm working from home. I can bring my laptop. And I just love diner coffee. That would be my pick.
I like the choice, actually. And then David.
Yeah, so I am definitely a big coffee drinker, and we are blessed that we have a number of great local coffee roasters here in Berkshire County, Massachusetts. In particular, there's one called Number 6 Depot, and they make a blend called Bali Blue Moon that I put in my espresso maker every morning. How's that for specific?
That is wonderful, and it made me think maybe for a future program, we take a little coffee truck on the road and we get up to the Berkshires and we make our way to Philly and we start doing this around the country. We do remote coffee podcast around there. But I want to thank both of you. We at OIC, OCC, and the Coffee with Cott group, we are so thankful for both of you because you've not only been such great supporters of what we do at the Option Industry Council, but also as a part of our outreach. I want to encourage our listeners, as always, to send in ideas, anything they might want to hear on a future podcast. Please email us at options@theocc.com. Again, appreciate Eric and David sharing their time, knowledge on the ETF options topic. And in closing, the acronym COFFEE, C, consider using, O, option strategies, F, for your clients, F, find various, E, educational resources, E, easily at optionseducation.org. Thank you all for listening. We'll hear from you soon.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.